Welcome. This is the Insider's Edge to Real Estate Investing with James Nelson, the principal and head of Avison Young's U.S. Investment Sales Group, and his co-host, Kim Troller, from his investment sales team. In this program, you'll learn game-changing strategies to outperform the market. James will teach you how to source, execute, and capitalize on the best real estate opportunities in New York and around the world. Now, here are your hosts.
Welcome, everyone, to episode number 235. This is your co-host, James Nelson, here along with Kim Troller. And today we are going to be speaking with Billy Haddad from Contrarian Capital. And you're going to learn about finding opportunities that often get overlooked in this episode. Billy is the managing director of Partners Path, a private family office specializing in identifying and cultivating partnerships that align with a vision of sustainable growth and value creation.
You'll hear about evaluating political risk, structuring partnerships, and spotting markets with the potential to deliver long-term returns. Billy also shares his views on sponsor communication, value-add strategy in industrial, and the importance of patient capital. Honestly, James, my favorite part of our conversation with Billy was talking about how working in real estate is a lot like being on a sports team and how each player kind of brings their own value to the deal, no matter what side of the table you're on.
You know, I love sports analogies, and my audience is probably sick of how often I post on water polo. Yes, all three of my sons play, including my oldest at USC, my middle at George Washington. But it's interesting. The Wall Street Journal actually wrote an article on why water polo athletes are great in business. It's because they think as a team. And I think that applies to all team sports. Can you work with people? Can you make quick decisions?
Right.
Can you come back from hardship? And so, Billy definitely speaks to that. I also just appreciate, the perspective. And it's always interesting to look at the portfolios, and especially for those who own multifamily in New York, that's kind of its own animal. And then he's also, they're also buying industrial across the country. So, clearly very different types of investments, but still, being very specific to kind of those two specific strategies. So I think our audience is going to learn a lot from this. Also, kind of the benefits of not just working, within the family office realm, but also the value of networking. He talks about all his Wharton connections that Kim, I know you share as well.
Yeah, absolutely.
Perfect. So we're going to have a brief word from our sponsor, and we'll get right into that interview with Billy Haddad.
Avison Young's United States investment sales platform executes on multifamily office, retail, development, and specialty asset transactions across top U.S. markets. As experienced leaders in the industry, our integrated national team is here to help you make informed investment decisions, whether advising on your current holdings or identifying new opportunities nationwide. Our one unified platform is built on unparalleled collaboration and connectivity across 120 full-service offices around the world, giving clients direct access to the deepest pools of capital. We put our clients first, delivering tailor-made strategies to achieve superior results.
Welcome, everyone. We are thrilled to have with us today Billy Haddad, who is Managing Director of Partners Path. We were connected with Billy through our friends at BizNow on the Ascent conference. So, Billy, thanks so much for joining us today.
Yeah, great to be here.
Good. So for our audience, maybe you could just give us a little background on Partners Path. I believe you've been there now about 10 years, but maybe give a sense of your strategy, kind of holdings in the market, just so everyone get a sense of what you've been up to.
Yeah. So we're a family office based here in New York. And I guess we have two main strategies. One is deals that we do in-house. So we have a portfolio here in New York that we own and operate in Brooklyn and Queens. And then away from that, in other asset classes and geographies, we partner with sponsors. So we kind of call it our emerging sponsors program, where our check sizes are usually in like that 2 to 7 million per range, per deal range. And I think there's a hole in the market in that spot. Like I think if your deal is 25 million or above, there's the same 10 to 15 players that are showing up for every single deal. But when you get into that single digit millions, right, you're too big for the dentists or the lawyers or the local players. But most of the larger players don't think it's worth their time. And so we found a little bit more alpha in that space. So we do this year a lot of industrial, and prior years a lot of multifamily. And we've been more active on the credit side as well.
Great. Yeah, I'm a general partner in River Oak NYC, and we raised two funds. I mean, this goes back, 10, 15 years, but our thesis and approach was exactly the need that you addressed, is that on one hand, 95% of the transactions are typically below $50 million in total capitalization. But when you look at the institutional equity out there, 95% of the capital is focused at 50 million plus. So there's this total mismatch where there's a lot of opportunities out there in the market, but not a lot of organized capital going after it, especially in that space that you mentioned that's kind of, a little bit larger than friends and family could take, or maybe you could get there, but it would take a lot more time and effort, but maybe also kind of below some of the larger scale opportunities that can be very competitive.
Right. Billy, what's the current balance like between multifamily and your other strategies like small bay, industrial, and are there any sort of areas that you're intentionally avoiding right now, especially with multifamily, or like what's your kind of breakdown?
Yeah, I mean, I think on the multifamily used to be, call it 80% of what we do, and now it's kind of stepped back just because I think in a lot of markets, the math doesn't make sense to us. We're still active in New York. We're one of the few people. I think, I always think of it as we're always looking for the empty rooms. Where do investors not want to be is something that, like go to a conference and someone says, oh, I would never invest in X. Then my ears perk up and I go, I need to learn more about X because there's probably an opportunity there. So like we've seen that in New York City multifamily. I think in the last 3 years, we've been very active because no one else seems to want to be there. And so we're happy to kind of, buy at over a 6.5 cap in some cases. But then I'll call, brokers in the Sun Belt and they're still at 5 and 5.25. And, vacancy is growing there. There's still a bunch of supply. Yeah. So that's caused us to pull back from a lot of the quote unquote hot multifamily markets. I think small bay industrial we've leaned into. I think that's a byproduct of also, I think the headlines have been there's tons of vacancy industrial. When you dig in beyond the headline, most of that's 1 million square foot and above. And so we've been playing in kind of that smaller 50 to 150,000 square foot buildings.
Got it. Yeah, James and I have both sort of seen in the sort of Southeast growth markets, cap rates are still kind of low 5, even sub 5 in some cases. So there's definitely a compelling argument there for New York multifamily, despite all of the political risk. And James can speak to this more, but he recently came out with a white paper that talks about how real estate values are really more impacted by the macro factors like interest rates and construction costs and things like that, as opposed to whoever's in office in the local market. I'm curious to hear your take on that, given your involvement in multifamily.
Yeah, I mean, I think I don't know. I think elections broadly have gotten very disconnected from the realities. I think it's a lot of the conversation isn't linked directly to like the policies or even the ability to execute on those policies. And I think that was the big story in the mayoral race was, I think Mamdani ran on a lot of things that he can't unilaterally do, and we'll see if he gets the buy-in to do it, which is the huge question mark. We did a similar kind of white paper for our investors because when he won the primary, I think a lot of people we were like, we got to get ahead of the headlines. We have to, be out there, and our takeaway from reading his campaign site and actually understanding the civics of it, right? The only thing he really controls unilaterally is the rent stabilization board, right? The annual increases, he can influence that pretty single-handedly. Everything else, he's going to need Albany or the city council. Like he needs further buy-in. And so, we were on the other side of that trade. If you think about where the headlines and where the sentiment was, we thought it was overblown. And so we took the other side.
Mm-hmm. So if you would consider yourself a contrarian investor, right? You talk about looking for the rooms that are empty, but I would imagine, clearly at some point that room has to fill back up. So, part of that has to do with withholding period, right? So do you have, now I know some of these deals you invest directly, and if it's on, I would assume you would tell me that if it's a direct investment, maybe there is no time horizon. Maybe this is for, generational type investment. Whereas a co-GP, typically there's a defined timeline, and at some point there has to be a capital event or a way to kind of crystallize the promote. So, if you're talking about New York multifamily, for example, and I agree, long-term seems like a great bet, but I think it'd be difficult to try to capitalize on that if you said, hey, we're going to get in and try to reposition this in 2 to 3 years. So it's probably a longer type investment thesis. So timelines based on whether you're investing directly on behalf of the family or as an LP.
Well, I think locally, I think, this year we just sold a deal in September to a very large player who's active in the outer boroughs. And so, I think if it's right for the deal, we'll sell, right? We're not wed to that. I think we've done transactions where 18 months in, someone, made us kind of the Godfather offer, and we said, please, we'll sell. In other cases, we'll refi out our money and say, why take the tax hit? We like the deal still. And, we don't have somewhere else to put it. But I think to the point of, with the local trade, you have to be confident in New York. And I think New York's kind of undefeated. And if I'm wrong on that, I guess I'll look like an idiot. But I think over many time periods in the past, people have said New York is dead. And I think we've seen otherwise. And I actually just don't think that we'll see. I don't think the new administration will be as revolutionarily different from prior administrations we've had. And obviously that's going to depend on Albany's buy-in and everything else. But I just...
So if you're making an LP investment, I mean, what's the typical hold period then? Are you giving kind of a 5-year period to execute on the business plan? Can that get pushed out to 7 years? I would think that maybe if you're making this New York bet, that maybe the time to capitalize on that might be, under a future administration. Yeah,
and or at a certain point, we bought some deals in 2020. We put 7-year debt on it, right? It was a 7-year kind of, and now we'll coming up to the point where we'll reassess. Do we want to refi or do we want to sell? So, and we don't do any kind of straight LP investing. So in all of our deals, we build in some kind of negative control rights. So we control refi and sale decisions. So
can you talk about, just for our audience, because I think that's really an important concept when you're taking on investments. So when you say negative control rights, can you just kind of explain to everyone what that means and kind of how you could effectuate, whether the decision is to sell or refinance a major capital event without actually sitting in that GP position?
Yeah. So typically, right. So a sponsor will find a deal. They really like the deal. They don't have the capital for the deal. They come to a group like us to raise the capital, and, we'll negotiate with them to say, look, we'll put, X into the deal, but if you want to do any of this list of things, whether it's sale, refi, major decisions, you have to come to us for our consent. And that's important to us because during the financial crisis, some people we're in real estate deals where they saw that the incentives can be misaligned in a downside case, right? A sponsor says, I'm never going to hit my promote, fire sale it, and doesn't do right by investors. So we build those in to protect ourselves in that situation. As I always tell sponsors, we don't have the headcount to do your job for you. So we don't view it as we're going to step in and take over. We just have it there as a protection mechanism against the downside scenario.
But what, just to dig a little bit deeper on that, because what if it is the opportune time to sell and you're kind of unreasonably withholding that ability? Or what if you said, okay, maybe the market value for the property is $20 million, but you say, hey, we're going to only sell and get 25. So what protections are in place then for your operating partner to know that they still have the ability to capitalize?
So in some cases we'll build in, right, that the consent isn't needed if the sales price is above a certain level, right? And so beforehand we'll build that into the doc so that they have that comfort.
Okay. So who are your main investors? Is it high net worth individuals?
Yes, we work for mainly two individuals. They sold a business, call it 25 years ago. And so we cover the kind of their real estate investment portfolio.
Okay. And you brought up a really interesting point earlier, which is investor communication. What is your general strategy towards communicating things like political shifts, economic shifts? Are you just very stringent with your reporting? Do you have a personal relationship with your investors? How do you kind of communicate what's going on internally and with your strategy?
Yeah, I think it's both, right? I think you need that constant communication. So we have that personal relationship where if there's something important, you pick up the phone and you call. I think for something that probably requires more thought and more depth, right? We'll put together a write-up or we'll put together something else to give that insight that's necessary, that you can't just have a 5-minute phone call to discuss.
Right. You also mentioned your real estate emerging manager program. Can you tell us about what that is, how it's structured, kind of how it came about, and generally what qualities you look for in sponsors that you partner with?
Yeah. So, the groups that we tend to work with are one of two types. So one is it's a group that they've found a niche. They've done a few deals. They've gone through, as you were talking about before, raising those small checks to get the deal across the line. But what they realize is that if they want to do more deals or bigger deals, the investor relations aspect of it's going to get very cumbersome. And so what we can do is use kind of, our check size to streamline that process for them. So they could say, we don't want them to lose their other investors, right? I think that's an important part of any growth for sponsors to, anyone who's interested in your deals, you should continue to keep around, but use our capital to help grow them more efficiently. Sorry. So I said one group is that they found their niche. They've done a few deals. The other is someone's working in a big shop, either the carry isn't going to be valued at what it used to be because of whatever. They don't see a path forward. They say, I'm going to start my own firm. In those cases, a lot of times they have the deal flow and the know-how. They don't have the capital. And so, we've kind of come in and backed a few people who have left kind of larger firms, as they've launched a new one.
And are these single asset syndications, or are they more of a fund strategy?
So usually we're creating a programmatic joint venture so we can go and do a series of deals. We kind of leave it to the sponsor. Some sponsors are like, I'm only ever going to do deal by deal. Others are, how quickly can I raise an institutional fund? I think that's kind of, I have my views on that, but we typically leave it to the sponsor to determine what they think the best path forward is.
Got it. So how do you decide if you want to approach a deal directly or as a JV? It might just be, how the deal comes in. So obviously if you have interest in a certain strategy, you buy it direct, or you wait till the JV partner to bring it to you, or how do you kind of figure out what path? And then maybe we could even go into a little bit about the considerations of kind of the benefits of being a direct investor as opposed to being a co-GP, which sounds like that's the way that oftentimes you approach your joint ventures.
Yeah. So, to date, the direct has just been local in New York, right? It's where we think we have an advantage, where we have resources, where we can focus. I think right now we're actually exploring, where do we expand that, right? Whether it's other parts of New York City, whether it's, nearby markets. So like markets that we find interesting that are kind of proximate are, the northern New Jersey area, the Lehigh Valley. We've looked throughout kind of upstate New York. There's some interesting pockets as you go into New England, right? So what we're trying to do is, where are there opportunities for us to grow? Where can we build kind of a beachhead that makes it worth growing there and doing it ourselves? I think the JV, investments tend to be things that like, we don't necessarily have the in-house capabilities to do it. And we're better off, working with somebody who can, tend to it day in and day out.
Mm-hmm. I mean, it's interesting because multifamily investing in New York is probably one of the most hands-on type of investments. I mean, not only, and I don't know if you use third-party managed, but even if you do, I mean, it's very nuanced, very technical understanding, everything about rent regulation and the way things are filed. So, I mean, it doesn't seem like it's a question of how management intensive an asset is, as you will.
Yeah.
I mean, it's not a matter of, we want to be passive in some areas and direct on others. It's just where you feel like you actually have expertise, as opposed to maybe going into something like you said that you don't have knowledge of.
Yeah, so for example, our portfolio in New York, we do all the private management in-house. We know all the filings. We are dialed in. And what we don't want to have is, someone sells us on a deal in Charleston, South Carolina, that we don't know like anything about. We're not there. If there's an issue, we have to get on a plane, right? And so in those cases, we want to have a trusted partner who's on the ground. Mm-hmm. Over the last 10 years, I've been pitched endlessly by somebody who's like, you should really do a deal in, insert market here. And I'm like, oh, where do you live in that market? And they're like, oh no, our office is like 2 blocks from you in Manhattan, right? And I'm not sure what benefit we're getting as an investor from somebody who's, not living and breathing a market day in and day out.
Oh, that's super interesting. Especially, we have a lot of listeners to the show that are, either aspiring investors or they've done a couple deals, but thinking about where they can gain that advantage, the credibility. If you're physically located in the market, again, you're seeing things, you're immersed in that market. So that's pretty telling, unless if you have the track record and demonstrate that you've already transacted there. And even then, I would imagine you have some boots on the ground to assist with something like that. What about the economic considerations? So obviously, if you go direct, there's no promote structure, whereas if you bring in a partner, especially if they're going to be doing the day-to-day, they're promoting you. But if you look at, and this is interesting because I don't think we've ever talked about this on the show, but kind of how your time is best spent, right? So a direct investment, no promote, but a lot of hours go towards running that investment. Whereas that JV, again, you're giving up that promote, but are you spending 1/10 the amount of time on that investment? And when you look at the returns at the end of the day, and where is your time best spent? I mean, do you all ever think of that? Does that go into the calculus?
This is a constant conversation in-house, right? Is, I think of it as where do the overhead costs sit, right?
Okay.
So for our local portfolio, right, everything is on our P&L, right? So we have a property management person, we have people who are pursuing deals, right? And so because we're going direct, we internalize that cost. When we work with JV partners, right, it's infinitely more efficient from our overhead perspective, right? Because the overhead's on someone else's P&L. They basically go out, they chase deals, they synthesize the deals, they vet them, and we get kind of the best of the best from their work. But we're not necessarily paying for that work, right, until we go and we execute on a deal. And so to some extent, I don't mind having a partner who promotes off of our capital because it's an upside expense, right? I'm not increasing my overhead at all, and they're only getting paid if we've done well on a deal. So, in those cases, we don't, to your earlier point about if you have negative control rights, how do sponsors get comfortable? And like we had a partner, the deal that we sold 18 months in, he came to us kind of, not sheepishly, but, it was like, hey, we got this bid, would you be willing to sell, And I think he was nervous. I think a lot of partners would have been like, wow, he's going to get a huge promote. Like, let's hold it. And we said, no, you did your job. You found us an investment. We made a lot of money. You should get paid off of that. And I think that too often people get lost in what are the fees that I'm paying and not what is the net return that I'm getting, right? Because that's the business that we're in. It's how do I generate high net returns? And sometimes you have to pay for that, right? I think, you see it in any, you go buy a new jacket at the store, right? You might have to pay a little more for a jacket that's actually going to last 10, 15 years, however long you want your jacket to last, right? If you are cheaper with kind of how you pay your people, right? Sometimes you're not going to get the best people. And so from our perspective, right, if we think our partners need to succeed just as we do.
Right. To bring the conversation back to New York, because I love the optimism and you clearly have the boots on the ground knowledge and belief in the city. What aspects of the New York multifamily market do you think are the most resilient, regardless of who's in office? And where do you see the biggest long-term opportunity in New York multifamily despite these political shifts?
Yeah, the biggest thing you're seeing, if you look at all the markets across the US right now, supply is the biggest question mark in all of them, right? And New York, right? We've seen it administration after administration. It's very difficult to build new units in New York to match the demand. And I think going forward, that's the thing that I think if there's a feature of the market that is most in its kind of win column, it's that, like we own a bunch of stuff out in like Bushwick and Ridgewood, right? It's a neighborhood that's just lined with these 6 and 8 family kind of buildings. There's never going to be, thousands of units overnight out there. And I think that is the insulating factor, right? I think if you go back, so I first started in this job, right? It's called 10 years ago. Then you had massive dispersion in cap rates, right? If you went to a Jacksonville, Florida, you were buying deals at an 8 cap. And if you're in New York, this is before the rent law, you're buying things at a 3 cap or, 1 cap, if it was rent stabilized, right? And you had this massive dispersion of markets. And the trade then was that those were going to kind of come together. Right. Everyone's borrowing from the same lenders at the end of the day, right? Fannie, Freddie, right? The borrowing cost is the same. So the asset pricing should have been more similar than the massive spread you had. Now they've all come together. Well, now that doesn't actually make sense because you go to certain markets and they've built, 15% of the unit count in the last 3 years. Rents aren't going to hold, right? Expenses have gone through the roof, especially depending geographically if you have insurance issues. And so now you're going to see that dispersion happen again. It hasn't happened yet. I think lenders have been very friendly to ownership, but I just don't, there are a lot of markets in this country that are having supply issues and you're seeing vacancy is ticking up. And at that point, right, the question then becomes what NOI are you using when you quote a cap rate, right? Are you using an in-place NOI or are you using what kind of a stabilized, fully leased NOI is? But yeah, I think from a New York perspective, you still have, right, people want to be here. You can't build that many units. And that math is going to lead to increasing rents.
Right.
So you mentioned about the investment philosophy of being a contrarian. And I definitely get that for multifamily in New York. Industrial, and I don't know if that's, I know you have holdings across the country. Industrial would not seem as much of an outlier strategy.
Yeah.
I mean, sure. Well, maybe now in some markets with new construction, talking about supply meant same way with multifamily. We're certainly seeing supply, whether we're talking about Phoenix or the Inland Empire, all of a sudden it's like too much of a good thing. So just getting your thoughts on the industrial market and where to play, because we hear a lot about this, shallow bays now, and what is it about that maybe is more attractive than maybe some of these big bombers that have the credit attached to them?
Yeah, I think the shallow bay, you haven't seen the same increase in supply, right? So I think the big bombers, I think everybody, right? Think about it. If I was an industrial developer, right, I could go build 1 million+ square feet, take the fees off of 1 million plus square feet and chase a credit tenant of Walmart and Amazon, right? The big players. Or I could go develop, a 150,000 square foot space where I'm not going to get the same credit in my tenant. I'm not gonna be able to take the fees of the same square footage, right? Like it makes sense why one is oversupplied and one isn't seeing the same supply bump. And so we've been playing kind of in that smaller bay. I think, it's like the old joke. If your taxi driver's telling you about an investment, right, that's the time to sell it.
Mm-hmm.
I think it is getting very kind of in vogue. And so now the question becomes, what's the next thing to keep your eye on, right? I think we've been pitched on, and I think we might do our first industrial outdoor storage deal. It's like the new, small bay, shallow bay industrial. I think that there are pockets where, the zoning has gotten difficult, or there's a ton of demand for that product. That's interesting. I come from originally a credit background. Like the other part of me says it's a parking lot, right? Like your barriers to entry are somewhat limited. At the end of the day, it's like it's a land banking play almost.
So from a geography standpoint, how do you get comfortable? And again, you made the whole point that you want that partner who has boots on the ground. Okay, so that's part of it. But how do you feel comfortable that there is that demand? And whether that's in shallow bay or multifamily, I mean, how are you tracking what the new supply or competition looks like?
Yeah, I mean, it's, probably the same data sources that everyone in real estate uses, but it is kind of a multi-piece puzzle, right? It's like, we want to find a market that we think has compelling dynamics. We want to find a partner we trust and has know-how, right? All those things have to kind of align. So in a lot of cases, there are trades or investment ideas that we like. We just haven't found kind of the way in yet. And so that's also part of the job, is to kind of find that fit.
Mm-hmm. So with New York, because you're, like we said before, your boots on the ground, you're living here, you're very confident in the city and the city's growth. With your shallow bay strategy, which is kind of all over the country, I read on your website that your strategy focuses more on markets with limited new competition. So what kind of gives you an angle there when you're not boots on the ground in these markets?
Yes, I mean, in some cases we're relying on the partner, right? So,
right.
So like that's kind of our way to tap into, okay, what are the best ways of thinking about this market? So in a lot of cases, it's like an infill location, right? So right now we're developing a building in Tempe, Arizona, right? So it's not far from the airport. It's, fully built around it, right? We found this nice piece of dirt. We're building a small industrial building. It's already 2/3 leased. We're doing a similar deal up in Glendale, in Phoenix. And so in those cases, right, it's a market where the headline would tell you Phoenix, tons of industrial supply, right? And when you pull like the CoStar, right, it shows this massive vacancy rate and you get really nervous. And then you back out the million square footers and you're like, oh, actually the vacancy rate's in the low single digits for this type of asset. And in both cases, we've de-risked it because it's 2/3 leased. And so the other third is speculative, right? We'll see, if we hit a massive recession, right, we'll have a 1/3 vacant building, but we're confident, even based on just the traction we've gotten post, putting a shovel in the ground, that we'll fill that space.
It's a great point when you're looking at what is the competition in the market, and when you're looking at these vacancy rates, just looking at the percentage on its own doesn't break out, again, the direct competition, to your point. Made me think about here, the apartment sale market. So if you look at the available condos in the market right now, which is at a 10-year low, but here in Manhattan, there's 3,000 units. But over a third of those units are in 6 projects, right? So you start looking, and that's why, if you're selling a piece of land on the Upper East Side for luxury development, I mean, if you looked at just the availability in that submarket, even for that kind of product, it's probably, a matter of maybe a dozen or 2 units, right? So I think that's a great piece of advice for our listeners, to really don't just look at that kind of top line vacancy number, but really figure out where is that coming from and doing your homework.
Yeah, I'm a baseball fan, so I always think of it as like the money ball of it, right? Like there's the headline, right? Like there's, hey, this guy has X stats, right? But you got to go that level or 2 below to say, well, what's the real story? Where's the data at? And is the headline actually communicating what the data is telling you? Because in a lot of cases, there's a large spread there.
How much of the data do you think, whether it's your competition or other investors, I mean, today, do you think most people are just kind of going with their gut feeling and what, looks good in a market, or they're really intensely studying the data? Like how much of your investment philosophy is really driven by the data analytics?
I think it's this weird, you can't be too reliant on it and you can't ignore it, right? Because I think like, was it Zillow or some of the home buildings, they had an algorithm go and buy stuff up and it didn't work, right? It was, and then I think, on the other side, I think that in some cases people follow kind of, where's the investor capital going, right? And I think sometimes that leads them astray, right? So it's like, oh, people really want X. And it's like, okay, well, at the point at which people really want X, is the trade still there or did you miss it? And now you're just coming in late to the party. And so I think it's always kind of just like, not getting too caught up in whatever the, story of the day is can also be a real benefit.
Billy, what is your approach to adding value with your industrial strategy? Is it more centered around leasing? Like maybe you get in at a below market lease and wait for the lease to expire and then bump the rents up to market? Or is it more capital intensive? Like how do you view the sort of value add play there with your industrial strategy?
A lot of it's just been on the leasing side. And part of that's that where we're still new-ish to, like we've obviously done industrial deals, but we're by no means, Prologis or an expert, right? Like, and so we've kind of taken two approaches. One is more of the leasing play of, hey, rents are at $12 a foot, market $16 a foot. And we like that too, because I think our patient capital opens that door. Whereas, there are certain opportunities that a typical fund, right? That story doesn't play for their investors or their time frame in the same way.
How do you know? Because I think it'd be rare if you're buying something from an owner who, they've got vacant space and they don't, have a credible leasing team. I mean, that probably does happen occasionally where they just have the wrong team. Maybe it's a friend, a relative, but they just don't know how to lease the space. But, other times it's more, maybe it's kind of where they are with their capital stack. I mean, I know we're selling a deal right now where the owner, there's plenty of leases that could be done, but they're not willing to fund TIs. Yeah. Right. And that's something. So I mean, maybe I'm answering my own question of trying to dig in and find out why whatever leasing program is not working. But how do you know it's not just a weak market and it's the leasing demand's just not there because it's not there?
Yeah, no, I think, well, the deals like the one you mentioned where you have the leases and not the TI cap, those are the deals you want to be doing, right? Because it's just a capital problem. It's not right? Like from where I sit, that, you're trying to put capital to work, capital solves that problem and you're going to get outsized returns. That's a good trade. Usually what we're doing is we're relying on, they have similar assets in the market, right? So we can see that, no, we just signed this lease at this number. In some cases, you're buying from a seller who isn't as savvy. Maybe they've been in the asset for a long time, right? And they haven't actually been in the leasing market, right? 10 years ago, they put everyone on a 10-year lease. They, went and they played golf and now they've come back and now, we're going to have vacancy, just sell it, right? I don't want the headache of it. And so it's just finding those kind of one-off opportunities, which like the crazy thing is real estate's the one asset class where that still really exists, right? It doesn't exist like, in public markets, like it's so monitored in most cases that you don't have just like hey, I just inherited this. I don't want it anymore. I'll sell it at a price. In real estate, you have those opportunities. They're not, common, but they do pop up, and you want to be there to be the buyer in that case.
Yeah, and to add one more thing, also no law that you have to sell the property for the highest price. I mean, it's not by definition, it's not a public offering. So again, whether or not the seller even does a good job, do they choose the right broker to do a proper marketing campaign? Do you buy it off market? So I mean, there's so many opportunities where you can gain that advantage.
Well, nowadays you also have sellers who don't want it advertised that they're selling, right? They have people who have, I have a debt problem here. I really got to get rid of this asset, but I don't want it known to the market that I'm selling this because I have all of this over here.
Yeah. See that the reasoning there, I mean, yes, maybe at the time, but after it sells, everybody knows anyways. Yeah. So, but yes, you totally get owners who say, I don't want to advertise, my issues. But Billy, I was going to ask you, how do you find for your JV investments, how do you get most of that deal flow? How do you get most of those sponsor introductions?
Yeah, I always joke in the randomest of ways. I think, sometimes it's just, a friend of a friend. I know we were both at Ascent, right? It's attending events like that, just being out there in the market, just trying to meet as many people as possible. And, and also like just kind of continuing conversations, right? It takes us a long time to get comfortable with somebody, right? So it's also like, having check-in calls with people once a quarter who, we haven't done a deal with. We might not do a deal with them this year, But, maybe next year as, they build out their track record, as they become more established, and as we get more comfortable with the asset class or the geography that they're playing in.
Mm-hmm. And how do you, just again, for our listeners who are trying to raise capital, what is it, beyond their track record and what they've done when they come to you? Is it a deck to say, is it a nice fancy website? What is it that they can kind of put themselves in the best light so you can see that they're credible and it has the information that you need to determine whether or not they're the kind of sponsor who you would back?
Yeah, I mean, I think you got to have like a Excel model that you can send to us. Like, I feel like I always find it weird. A lot of groups are like very proprietary about their Excel. Like everyone's using the same, like they make you sign a bunch of NDAs, and I'm like, it's not, it's not a state secret. I think that's like that, and a deck or some kind of write up or something about the investment you kind of need to have. Right. Like I've had meetings with people who are like, they keep talking about the deal, and I'm like, well, just send me the materials and we can have a more educated conversation about it. So yeah, so I guess those, I think. Do
you want them to have control over the deal? Because that's always, it's kind of that chicken and the egg where as the sponsors trying to decide, do I sign this up? I don't know if I have the capital. You don't want to waste your time chasing something that's not a live opportunity. So are most of these sponsors bringing, live deals to you where they're saying, hey, I'm thinking of bidding on this. Are you on board?
It's a mix.
And I'm sure that NDA piece, if you don't have deal control, I'm going to let them know. And then, suddenly it's going to be out in the market and I'm going to lose it. Right.
Yeah. Well, I mean, we would never, if someone sent us a deal, we would never then go do it. I just think that's too slimy and sneaky. But I think, sorry, what was
well, just when do you like to come into a deal? Is it okay if they say, hey, we're bidding on this deal? Or do you want to actually have it under control where?
I don't think having it under control is as important. I know a lot of people tell sponsors that like and I think, look, I think if I was at, bulge bracket name brand PE firm, I tell them go get it under control because I know the other three guys bidding on it and I can only work with the person who gets it under control. Right. So I don't want to know about it until it's under control, and then I'll underwrite it that one time with that group. But I think for us, it's more of building a conversation over time with different groups. And so if they're out chasing a deal and they say, hey, look, we bid 15, it wound up going for 16 and a half, right? Like, I guess one, I know that they're kind of on the conservative end of things. They're not like leaning in too far. So that can be a good data point at the same token, right? Even though that, it was a waste of time because they didn't get the deal.
And are you ever putting up deposit money alongside them or guarantees?
We have not. I think we'll participate, I guess, if we've worked with someone before, right? And you get to like that fifth, sixth deal and like we know we're going to do it, then like we might start participating in deposits, but definitely not on like a first deal with somebody.
Got it. That makes sense.
Billy, I would love for you to talk about your experience at Barclays in credit risk and public finance and how that sort of led you to the family office world with what you're doing with Partners Path today.
Yeah. So I started at Barclays. It was a rotational program. So it's leverage finance, real estate, and public finance or municipals. I did a couple of years in that and then mostly did public finance. So like we covered transportation names, so like airports, and Puerto Rico is our big. So in like 2013, we did like a $3.5 billion restructuring for Puerto Rico, which was definitely a busy and fun experience. But I think I did investment banking long enough to realize that I didn't want to do it forever. Yeah. And then was connected to my current shop, and it's 10 years. So it's been good.
I think it's so amazing with real estate, how people come from such diverse backgrounds and end up in this space. How has your experience in the banking world shaped your perspective on real estate and your strategy?
Well, I think it just like broadens kind of like my perspective. So for example, like, as cap rates got super low, right? From like fixed income investing, that the present value of a basis point gets massive when interest rates get low. And so like to put that into plain English, like the lower your cap rate is, the more you win, the more you can lose by a very small move in interest rates. And so I think what people missed is how risky it was to invest at very low cap rates, which I think that like when you come from a broader finance background, you've seen this in fixed income. Whereas I think in real estate, people sometimes don't have that broader lens. Because I mean, right, in a lot of cases, real estate, it's so linked to interest rates, right? But if you inverse it, right, you can take it as a multiple play, right? So like if something's trading at a 4 cap, it's really trading at 25 times earnings, right? Put into like more of a equities parlance. And so the question is, right, if the S&P is trading at 1 PE multiple, right, I think you have to think about your portfolio more broadly. Whereas I think people in real estate just get trapped at like, it's an X cap, and they don't dig into like on what NOI, on what assumptions. And I think that, your KPIs can mislead you at times, and if you don't kind of dig into it.
Yeah, there's so many things that, if the cap rate is ultimately what you're going to use to solve for value, I mean, there's so many subjective factors that go into that can impact it.
Well, I see it from my end, right, where sponsors will say, well, what returns are you solving to? Right. And like, I think a lot of people quote IRRs, and it's like, well, IRR doesn't mean anything unless you tell me what your exit cap rate assumption is.
Right.
Right. Because I can play games on the exit cap rate assumption all day to make the IRR whatever you want it to be.
Yeah.
And I think that's another game that, like, I think there's a lot of sponsors who they underwrite the deal, and then they change the exit cap rate to get to the IRR they think the deal needs to have. And I think that's like a red flag of like, hey, like, no one's selling this at a 4 cap, like, let's just be realistic.
Yeah. I would think a stabilized yield on cost. I mean, what are you really solving for? I mean, it's hard to, again, kind of artificially.
It's the truest metric.
Yes. So I was going to ask both of you, coming out of Wharton, how much, again, there's so many incredible real estate professionals that have come out of Wharton. I mean, how, to our listeners out there, and we've got some students out there too. I mean, how important is that network, right? I mean, is it, maybe it was, I'm sure it was helpful in getting your first job out of school, but how much do you continue to lean on that network, and how much is there?
Billy, you go ahead first.
Yeah, I mean, I think going to a school like Wharton, right? Like, one, it makes like getting out of school, that first job, much easier, right? Because the employers come to campus, right? Like, right. I think that's like, my mom kind of advises people on applying to colleges, and people have all these different reasons why they pick their colleges. Like, I think like understanding where do employers want to go to get employees is like never on anyone's list, but it's arguably the most important. So it's an invaluable asset, kind of having that. Also, just having it on your resume, right? Every resume you submit after that, you have it. But yeah, I mean, the network's unbelievable, especially in New York. I feel like everyone graduates from Wharton, comes straight to New York. And so this is, even though Wharton's obviously in Philadelphia, like New York is where the alumni base is. And so like I'm involved with the Wharton Club of New York. Right. It's a great way to kind of stay in front of people and meet new people.
Yeah. I mean, Penn had a lot of real estate mentorship programs in place when I was there for undergrad, and like it's up to you if you want to continue those relationships. I've kept mine, since graduation, but there are a lot of networking groups that exist, and that, again, it's like you get out of it as much as you're willing to put in, and that goes for any networking group. Like I know, James, you're very involved with ULI, and if you're on a product council or something like that, and you get very involved, like that's how you really reap the benefits. And I think the same rings true for thinking about your alumni network.
Yeah. The advice I would have for our listeners, and obviously when you have a specialized degree, and Wharton has such incredible real estate programs, but even if so I went to Colgate, liberal arts education, English major. We didn't even have real estate classes there, but I will tell you that our Colgate Real Estate Council that we have, and again, small school, but we'll have once a quarter, we'll have 30 or 40 people show up to a breakfast, and it's a pretty high powered group, so the point is, regardless of what where you went to school, lean into that network, because generally, you have that shared experience to start with, and typically alums are going to kind of look out for others. So that's definitely something to think about. So
I think it's also, it's not rocket science, right? That's the other thing about real estate, right? Is that, I think that, like when I was at Barclays, right? You graduate from college, and then I think it was June or July, you show up, you spend the summer going through this like financial boot camp, because they have English majors and kids who didn't study business undergrad. And, in 6 to 8 weeks, they kind of get them up to where you are, right? You have more depth probably, but it's not becoming a doctor, right? Like this is something that anyone, you're right. Like it doesn't take that long to learn the basics of real estate and actually have an edge. And half of it's hustle and hard work, right? I mean, the people who can, I always say that like, the people who in a lot of cases would be the most successful on the real estate investing side are the brokers, right? They know the people, they know the deals, they know the tenants, right? And like, right, they're in a different role, but if you put capital behind them, right? They would have the best deal flow and know all the players, right? And so, I think you don't need to have this tailored background to go into real estate or really most other professions, right?
It's interesting that you mentioned, brokers are so well positioned to go onto the investing side, and a lot of them, including myself, I would say most of the way we're doing that investment is kind of on the LP side. Say, hey, we're busy, and also I think you want to be aware of not creating that conflict where if you're brokering, but you're, also a buyer in the market, and how does that work? But I think it's also, once you're a successful broker and you're doing transactions, it's hard to kind of stop that machine whereas when you're going to do an investment, I mean, it could be a couple of years before you see any economic benefit. Yeah. And not that a brokerage deal doesn't take 6 to 9 months, maybe from start to finish, but it is surprising that you don't see more brokers get involved and going full fledged under the.
I get it because we just sold a deal, and the broker who sold it gets a nice check. And, me and my colleague had been, in the deal for 10 years. Right. And, that's the first time we had seen anything from it. And,
right.
So it's, everybody has their own kind of incentive structure. Right.
Right. I also think you bring up an interesting point about coming from a social science background. I think people who come from more, non-business backgrounds do bring a really unique perspective. And if you're very in tune with policy and zoning and things like public-private partnerships and incentives, like all of these factors are kind of coming together to make these deals happen. And if you just have like a cookie cutter finance understanding and aren't thinking about the bigger picture, I think it can be limiting for some people.
Mm-hmm. Yeah. So, Billy, as we start to wrap, and it was funny, and you kind of mentioned the Moneyball aspect. I saw, I don't know if it was at Wharton, you were part of a sports, was it kind of almost like a fantasy football kind of thing, or was it more sports management? What was I thought there was some attachment to, sports analysis. And I'm just trying to think about kind of the gamification of this and like the metrics. And so, I don't know. I mean, I just, parallels that you see and kind of takeaways from that experience and kind of how you look at maybe, sports and the numbers and where you see the opportunities in real estate.
Yeah. I guess I forget what would have been on there. I think, did your son play water polo? Is that right?
Yes.
Yeah. I played club water polo at Penn.
Okay.
So I remember seeing that on your posts. Yeah. I think actually I think we're kind of talking about it, whether it's like English major or multidisciplinary kind of background, right? Like things like sports or other interests can, right? Like that analysis or that thought process, right? Can be really helpful in real estate or any other endeavor, right? And so I think it's important to always kind of, not just get lost in kind of, right? I think like there's certain people who like all they do is real estate. Yeah. And I think it has benefits, right? Like to be that locked in, but I think you can do other things that will bring in insights and understanding that you wouldn't have if you're just kind of staying in your lane of real estate focus.
I think there are a lot of parallels too between sports and real estate, especially in brokerage. It really does feel like you're practicing with your team, you're getting ready for the game, and you have the pitch, and it's like the rush and all of the things that you experience from being a competitive athlete, I think are kind of channeled in real estate as an industry, and that it makes it very like fulfilling for a lot
because a real estate deal is a team sport. Right. You need the equity to come in, you need the debt to come in, you need the broker, you need the buyer. Like all of these people need to work together to actually get to the closing table and get the to get the job done, as it were. And like, one of my takeaways from Ascent was that right now the equity capital seems to be the part of the team, right? That's not really performing in the way that the rest of the players in the market want it to, right? I think the debt capital player, right, is playing at 120% right now, right? And I think that the market's trying to synthesize, okay, we have all of this debt capital coming in, whether it's private capital, whatever. The equity capital is more conservative right now. And how do we rework capital structures and deals such that the generous debt proceeds we're getting can kind of lump in with a GP, and whether it's an LP or, now I feel like everyone, no one wants to be just a regular LP, right? Everyone wants kind of special treatment. And that's a result of the fact that equity is harder to find. And so I think that, bringing creativity, right? Bringing those kind of other skills to say, okay, well, the GP's putting X in. What if the quote unquote LP comes in as preferred equity? I think is a more common structure we're seeing. How do we recut kind of the upside splits so that the sponsor feels like they're getting rewarded, but the LP or the investor feels like in a downside scenario, they were getting better protected. because effectively both of them can benefit from the fact that now, you can get construction financing in the low 2s, right? And, that's something that equity should be benefiting from. That was kind of my takeaway, was like, should we be looking at more development? Like, it sounds crazy to say with all the supply kind of concerns, but, it's cheaper now to get capital for development than it used to be. And if everyone thinks you're nuts to go in the ground today, maybe you're not so nuts.
Going back to that empty room comment. I mean, when it was asked in front of a room full of investors, how many of you are putting out debt for residential construction? And like 100 hands went up. And how many are you doing equity? It was like 1, maybe 1.5. And then when really pressed on, it was, unless if
everything's perfect.
So, well, Billy, this has been awesome. Just one last piece of advice for the audience. I mean, your decision to be, and maybe it's the best of both worlds, because you're getting the chance to invest direct, but also as an equity participant. And any thoughts of, our listeners who are looking to get into investing, kind of, is it better to go kind of work with an operator that's doing deals direct, kind of working on that equity side where you get a lot of exposure to a lot of different kinds of deals? And any thoughts on the best path?
Yeah, I think the older I get, the more I come back to there is no best path, right? There's just get on a path, and keep working hard and moving down that path. Like I always joke, when I'm one of 6 kids, and so I'm the oldest.
Oh, wow.
So when I was younger, my dad always told me you should, learn Chinese, right? And then it became, you got to learn to code, and you got to, right? And I think the hard thing is that at the time that was the right advice. Now, right? Like I can pull out my phone and my phone will speak Chinese. Right. Or right now it's like coding jobs are getting taken over by AI. And so like it's so hard to know where the puck is going. And so I think that instead of like sitting there over analyzing what the next step is, just take a step. Right. And just keep, the harder you work, the luckier you get, and just keep, showing up every day. That's, 95% of success is just like working as hard as you can. And there's no, in 2007, the guy who got staffed on the restructuring desk at his firm thought he got like the worst position ever because there had been no restructurings in forever. And now 2008 comes and he's sitting in the pole position. Right. So you never know what the future is going to bring. And I think you just got to trust that hard work will move you forward.
Awesome.
Love that.
Well, Billy, this was fantastic. Thank you so much for coming and sharing your story. And we want to thank all of our listeners. And as we always say with this show, really the best thing you can do, assuming you got as much value to this episode as we did, is to share it with a friend. So forward this on. I do that all the time. And you can go to jamesnelson.com. The site is not about me. It was built for you. And so that's where you can find the show notes, how to connect with Billy. There's a lot of other helpful resources. We're going to be launching a course in the new year based on the Insider's Edge to real estate investing. So keep a lookout for that. That'll be on the Investors in Commercial Real Estate platform. And as always, thanks again for joining. Until next week.
Thank you for listening to the Insider's Edge to Real Estate Investing. We appreciate your subscribing and sharing with your friends. If you haven't already, please connect with James at James Nelson NYC on LinkedIn, Instagram, and Twitter. Please also visit jamesnelson.com, where you can sign up for our monthly newsletter, find the show notes, other episodes, exclusive video series, and other helpful resources so you can gain the insider's edge to real estate investing. Until next week.
This podcast is for educational purposes only and should not be relied upon for investment decisions. The opinions expressed are those of the guests and not their companies. Listeners should not act upon the information without first seeking appropriate advice from an accountant, lawyer, or other professional.